All right, today we're diving into the latest financial report from MARUWA, a really interesting player in the ceramics and lighting space. And what a story it is. It's full of contradictions. We're talking about some tough times right now, but at the same time, some absolutely huge ambitions for the future. And it all really comes down to this one central puzzle. How is it possible for a company's sales to be falling while at the exact same time they're forecasting their best year ever? It just doesn't seem to add up, right? So let's dig in and figure out what's really going on here. So here's how we're going to break it down. We'll start with the tough Q2 numbers. Then we'll look at the story behind them, the headwinds and the bright spots. From there, we'll check out the company's incredibly strong financial foundation, see why they're betting on a big comeback, and then we'll wrap it all up with the big picture. Okay, let's get right into the scorecard for the first 6 months of the year. And you might want to brace yourselves because at first glance, yeah, it's not exactly a pretty picture. First up, net sales. That's the total money coming in the door. It's down nearly 5% compared to last year. Not great, but honestly, that's just the start of the story. Because look at this. Operating profit, which is really the core profitability of their main business, took a much bigger hit. We're talking a drop of over 15%. Now that's a serious decline. And it doesn't stop there. Ordinary profit, which kind of bundles in other financial things outside of their main operations, is also down, falling by more than 7%. And finally, the bottom line. The number that's left after everything is paid for. Net profit, down over 12%. So yeah, you look across the board, from sales all the way to profit, and it's clear they had a really tough first half. And this table really puts those percentages into real money. You can see net sales fell from almost 35 billion yen to just over 33 billion. And you can literally trace how that drop just cascades right on down through every single profit line. The big question, of course, is why? To figure that out, we have to look under the hood at the company's two main businesses. And what we find is pretty incredible. It's like we're looking at two totally different companies living under one roof. So check this out. It's kind of wild. Their ceramic components business is basically the whole show. It makes up almost 90% of all their sales. The lighting business is just a tiny sliver of the pie. Now you have to keep that imbalance in mind because it is the key to understanding what's coming next. And boom, here it is, the great divide. Look at the ceramic side, the massive part of their business. Sales are down and profits fell off a cliff, dropping a steep 16%. But then you glance over at the tiny little lighting segment, and wow, its profits just skyrocketed by over 42%. So what in the world is going on here? Well, the trouble in their biggest business really came from outside forces. The market just wasn't cooperating. The global automobile and semiconductor industries hit a rough patch. And when those giants slow down, a component supplier like MARUWA feels that pain directly. But on the flip side, that smaller lighting business was just crushing it. This was all driven by strong demand for their high-end products, a nationwide push in Japan towards LEDs, and a growing market for luxury condos. It was basically a perfect storm of good news for them. Okay, so we've got this picture of a company getting slammed by some serious market headwinds. So how do they handle that? Well, it all comes down to their financial foundation. And this, my friends, is where MARUWA's story takes a very, very positive turn. It all comes down to one single number. 91.5%. That's MARUWA's equity-to-asset ratio. And honestly, this number is their superpower. Now, for anyone who's not familiar, this ratio basically tells you how much of a company's stuff is paid for with its own money versus how much is funded by debt. And a number over 90%, that is just insane. It means the company has almost no debt and is incredibly stable. Think of it like a giant financial shock absorber that lets them take a tough quarter like this and just focus on the long game. And it's exactly because they're sitting on this rock-solid financial footing that they can look past a few bad months and make a really bold bet on the future. So now, let's take a look at their forecast for the full year. And here it is. This is the slide that solves the whole puzzle from the beginning. Despite that rough first half, MARUWA is forecasting a nearly 5% increase in sales for the full year. They're not just hoping for a better year, they are explicitly stating they expect to achieve record high results. That means they are counting on a massive turnaround in the second half. Okay, so where is all this optimism coming from? Well, they're banking on a few key things. A big recovery in those auto and semiconductor markets, a huge acceleration in their telecommunications business, and, you guessed it, riding the massive wave of demand related to generative AI. And you know they're serious because they're putting their money where their mouth is. Look, companies that are worried about the future don't increase their dividend, but MARUWA plans to raise its annual dividend. That's a powerful signal of confidence to investors. And their ambition doesn't just stop at the end of this year. This quote from their report lays out a huge long-term goal, hitting 100 billion yen in sales by 2029. They believe, even with the current headwinds, that they're still on track.
So we've looked at the numbers, the different parts of the business, and the forecast. Let's zoom out now and put all the pieces together. What's the key takeaway from all this?
So here's the story in a nutshell. MARUWA faced a short-term challenge because of market slowdowns that were totally out of their control. But, and this is the most important part, their financial health is just off the charts. That incredible 91.5% equity ratio acts as a shock absorber that lets them ride out the storm. And that stability allows them to bet big on a second-half recovery, a recovery driven by AI and next-gen tech. And that's it. That's how you get a tough first half, followed by a forecast for a record-breaking year. So this leaves us with the big question, doesn't it? MARUWA is hitching its wagon to some of the fastest-growing technologies on the planet. But as we've just seen, global markets can be incredibly unpredictable. So, will this high-tech bet be enough to navigate all that economic uncertainty and carry them all the way to their ambitious 100 billion yen goal? Well, only time will tell.